Hi, this is Juliet, a young Orfiano. Welcome to my video. If this is your first time on my channel, please like, share, and subscribe so I can notify you if I have a new video. This is the continuation of part 7 about investments in equity securities and debt securities. I discussed in part 7 about investment in associates. Just click above or the link below this video to watch part 7. In this video, I am going to discuss about investment in debt securities. Investment in debt securities. Debt securities are financial instruments issued by a company that typically have the following characteristics. Letter A maturity value. Letter B, an interest rate that specifies the periodic interest payments. And letter C, a maturity date. Typical examples of debt securities are bond certificates and treasury notes. Bond certificates are certificates of indebtedness issued by a company or government agency guaranteeing payment of a principal amount at a specified future date plus periodic interest. They may be divided into different denominations such as 1,000 pesos, 2,000 pesos, or 10,000 pesos to encourage a substantial number of investors to purchase the bond issue. Debt securities such as bonds may sell at a price different from the face value of the instruments. The bond's market value is a result of an interaction of a variety of forces such as the current interest rates, expected future interest rates, and the stated rate of interest on the investment. When the rate of interest stated on the bond is equal to the rate of return desired by investors or the effective yield or market rate, bonds will sell at face value. If the stated rate, however, is greater than the market rate, purchasers of the bonds will pay more than face value, resulting to a bond premium. If the market rate is higher than the stated rate of interest that the bond offers, purchasers of the bond will pay less than the face value, resulting to a bond discount. In several instances, the issuance price of bonds sold at a premium or discount is quoted as a percentage of the face value. For instance, if 1 million bond issue was acquired at 102, this means that acquisition cost of 102% of the face value or 1,020,000 pesos if acquired at 95.5, then acquisition cost is 95.5% of the face value or 955,000 pesos. The market price of a bond can be determined by discounting the maturity value of the bond and each remaining interest payment at the market rate of interest for similar debt on that date. To illustrate the computation of a bond price, assume a 5-year, 1 million pesos, 15% XYZ company bonds are purchased. The effective interest rate for similar bonds is 12%. Interest on the bonds is payable semi-annually. Present value of maturity value, face value, x PVF of 1 peso at 6% for 10 periods. 1 million pesos times 0.558395 is equals to 558,395 pesos. Present value of 10 interest payments interest per period times PVAF of 1 peso at 6% for 10 periods. Interest per period is 1 million times 7.5% is equals to 75,000 pesos. 75,000 pesos times 7.36008 is 552,006 pesos. Total present value or bond price, 1,110,000 pesos 401. Alternatively, computation of bond price is discount or premium. Difference in interest rates times face value times PVAF. Bond price, face value minus discount or plus premium. Premium is 7.5% minus 6% times 1 million times 7.36008 is equals to 110,401. Bond price 1 million plus 110,401 is equals to 1,110,401. Classification of investment in debt securities. For accounting purposes, investment in debt securities are classified under one of the following. Letter A, trading securities or financial assets at fair value through profit or loss. Letter B, available for sale securities, or letter C, held to maturity securities. Trading securities and available for sale securities have been defined and described in the preceding section of this chapter. Debt securities classified as trading are those that are acquired principally for the purpose of selling or repurchasing in the near term. Held to maturity investments are non-derivative financial assets with fixed or determinable payments and fixed maturity that the entity has positive intention and ability to hold to maturity, other than those that the entity upon initial recognition designates as at fair value through profit or loss or as available for sale securities. Thus, to qualify for presentation as held to maturity securities, two conditions must be met. Letter A, the enterprise has a positive intention to hold the securities until maturity date. And letter B, the enterprise should demonstrate an ability to hold the securities until maturity date. An entity shall not classify an investment in debt security as held to maturity if the entity has during the current financial year sold or reclassified more than an insignificant amount of held to maturity investments before maturity. The exemptions to this rule are as follows. Letter A, the sale or reclassification is so close to maturity that changes in market interest rate would not have a significant effects on the instrument's fair value. And letter B, the sale occurs after the entity has collected substantially all of the financial assets original principal through scheduled payments, or the sale is attributable to an isolated event that is beyond the entity's control, is non-recurring, and could not have been reasonably anticipated by the entity. Other than the exemption cited, a sale of a previously held to maturity security before maturity date taints the company's ability to hold the securities until maturity. Thus, the second criterion is presumed to have not been met by the entity. Available for sale debt securities are those acquired that are not designated as trading, nor loans receivables, nor held to maturity investments. Debt securities classified as financial assets at fair value through profit or loss. Debt securities acquired and classified as financial assets at fair value through profit or loss are initially recognized at purchase price, which equals its fair value at the date of acquisition. Transaction costs incurred are treated as expenses and do not form part of securities costs. While the debt securities are held, interest income is recorded based on the instrument's stated interest rate. At financial reporting date, debt securities held classified as trading securities are adjusted to market values, with any change in market value taken to profit or loss. Illustration: ABC Corporation on March 1st, 2008 purchased the 15% 1 million face value bonds of XYZ Corporation for 1,110,401. These bonds mature on March 1st, 2013. Pay interest semi-annually on March 1st and September 1st. The securities at the date of acquisition were designated by ABC as trading securities. On December 31st, 2008, the bonds are quoted in the market at 112. On May 1st, 2009, ABC sold the bonds at 111.5 plus accrued interest. The following are the entries that reflect ABC Corporation's transactions for the years 2008 and 2009. 2008, March 1st. Debit trading securities, XYZ bonds, 1,110,401 pesos. Credit cash, 1,110,401 pesos. September 1st, debit cash, 75,000 pesos. Credit interest revenue, 75,000 pesos. 1 million times 15% times 6 divided by 12. December 31st, debit interest receivable for 50,000 pesos. Credit interest revenue for 50,000 pesos. 1 million times 15% times 4 divided by 12. December 31st, debit trading securities, 9,599 pesos. Credit unrealized gains or losses on trading securities, 9,599 pesos. Computed as market value, 112% times 1 million is 1,120,000 pesos. Cost, 1,110,401 pesos. Increase in market value, 9,599 pesos. 2009 March 1, debit cash for 75,000 pesos. Credit interest receivable, 50,000 pesos. Credit interest revenue, 25,000 pesos. May 1st, 2009, debit cash, 1,140,000 pesos. Debit loss on sale of trading securities, 5,000 pesos. Credit trading securities, 1,120,000 pesos. Credit interest revenue, 25,000 pesos. Selling price is 1,115,000 pesos, computed as 1 million times 111.5%. Accrued interest from March 1 to May 1, 25,000 pesos, computed as 1 million times 15% times 2 divided by 12. Total cash received, 1,140,000 pesos. Selling price, 1,115,000 pesos. Carrying value, Market value, December 31st, 2008, 1,120,000 pesos. Loss on sale, 5,000 pesos. Purchase between interest payment dates. If a debt security is purchased between two interest payment dates, the buyer pays in addition to the purchase price the amount of interest accrued from last interest date to the date of purchase. Such accrued interest is charged to interest receivable. Assume that X Corporation purchased on May 1st, 2009, 200,000 12% face value bonds of Y Company at 102 plus accrued interest. These bonds pay interest every March 1st and September 1st. The amount of cash X Corporation pays on May 1st, 2009 is 208,000 pesos computed as follows. Purchase price, 204,000 pesos, computed as 200,000 pesos times 102%. Accrued interest from March 1st to May 1st, 200,000 pesos times 12% times 2 divided by 12 is 4,000 pesos. Total cash paid by X is 208,000 pesos. On May 1st, 2009, X Corporation will record the transaction as follows. Debit trading securities, Y Company bonds, 204,000 pesos. Debit interest receivable, 4,000 pesos. Credit cash, 208,000 pesos. The receipt of interest on September 1st will be recorded by X as follows. Debit cash for 12,000 pesos. Credit interest receivable, 4,000 pesos. Credit interest revenue for 8,000 pesos. Alternatively, for convenience, the interest paid on May 1st may be charged to interest revenue. Nominal approach. In such a case, the receipt of 12,000 pesos interest on September 1st shall be recorded in the usual manner, crediting the full amount to interest revenue. This alternative achieves the same effect as in the first set of entries. The net interest revenue recorded by the investor from May 1 to September 1 is 8,000 pesos. Thank you for watching my video. I hope you learned something from this video. I did part 9 and continuation of this video wherein I discuss in part 9 about held to maturity securities. Just click above or the link below this video to watch part 9. Don't forget to like, share, and subscribe on my channel so I can notify you if I have a new video. Once again, this is Juliet Orfiano. See you on my next video.